Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today we're talking about an important topic about the state of the credit markets. Whether you are a seasoned investor or just an individual investor looking after your own accounts, this is an important topic. Joining me today is VanEck's very own head of fixed income ETF portfolio management, Fran Rodilosso. Fran, thanks for joining me today.
Hi, Ed. Thanks for having me on.
Now, you've been on the show before as a co-host, so today is all about you. And I'm glad we could bring you on and to chat with you a bit. One thing I note from your background, and I think is interesting for people to know about you, you're a fixed income guy through and through. Your career is pretty much all based on fixed income, right?
Yeah, which does not speak to an exciting lifestyle, for sure. But that's correct. About 27 years in bond markets. I had 1 year in commodity markets between undergrad and grad school, but almost everything I've done has been in the fixed income realm.
And so at VanEck, when did you join VanEck? 2012, is that right?
I joined VanEck as part of the ETF portfolio management team in 2012. However, I also joined VanEck in 2001 as part of an active EM debt strategy. That business eventually spun off from VanEck, but that was actually involved in the emerging market space, mostly in distressed debt. I guess my career is in thirds. I've spent almost 9 years now as a passive manager. I've spent about 9 years as an active manager, and about 9 years on the sell side as a sell side trader, both prop trading and market making. So I've definitely seen the space from a few different perspectives.
And today you oversee not only an EM debt strategy, it's based on an index. Of course, you oversee the Fallen Angel strategy, as well as some other corporate strategies as well. Do you find that your active management experience actually helps you in managing to an index?
Yeah, in some interesting ways, it really does. And I'm always careful with that response because the idea is not, we have these passive funds, but I'm an active manager, so let's add a little juice to it or something along those lines. Our portfolio management goal across all of our products is to best track the underlying index for each fund. But where the active management experience has helped a lot is really in two ways. One is every fund we manage to a different degree has some kind of sampling quotient. In the credit space, in emerging markets, for instance, it's not, especially in high yield credit, by the way, it's not easy to fully replicate the underlying index within the portfolio. Another important thing is just managing around liquidity. If we were strictly passive 100% of the time, and we try to be as disciplined as we can, but you cannot trade every rebalance for high yield bonds on the close of the last day of the month when your index rebalances. So just managing around liquidity and market impact of those rebalances, getting it as close to the rebalance time and date as possible, but with as little impact as possible. I find that having experience doing that in the active space has been quite helpful.
So would you say liquidity is the major factor in terms of how you assess a bond that you select to sample with in order to track an index? Or do you look at their credit as well, or potential for defaults, duration matching, anything like that?
Yeah, so we have, and by the way, if we tried to match everything perfectly in a fund where the sampling quotient is higher, we'd get infeasible solutions all the time. So we employ all of these factors, but we use them as soft constraints. And what we'll have to do is for certain funds, rank constraints higher than others. So for emerging market debt, geographic risk, especially country of risk, is such an important factor. That's much more important than, let's say, if you're looking at developed market high yield, where sector would be more important than country of risk. So sort of ranking those attributes, but what you'll find is what we're trying to minimize is the total difference between the index and the fund across a variety of things, including duration for certain, particularly the higher up the credit quality curve you go, tighter you want to be on duration. But also sector and geographic risk and credit quality. But we need to be very careful about how we sample within that group, and we put very tight constraints on overweights on individual issuers. So, idiosyncratic risk doesn't pose a major threat to tracking our index.
So passive management does not necessarily mean not engaged. You're definitely, it sounds like you're actively engaged in the management of that fund.
We are actively engaged. It's a really good way to put it. But the real key is that everything we do is toward track with the goal of tracking. We could have opinions on specific credits, but the bigger question is, if we're overweighted, how does that pose a risk to tracking? If we're underweighted, how does it pose a risk to tracking? And we're really not always looking on a credit by credit level in that regard, but we have to from time to time, particularly the smaller the fund is.
Well, let's talk a little bit about the state of the credit markets today. According to SIMFA, there's been a fair amount of issuance, something like 1.9 trillion towards the end of September, of new investment grade and high yield debt issuance. Does that tell you anything about the state of the credit market today and for the potential future of the credit market going forward?
It tells you a lot. It's interesting. Most years you would think, all right, we're setting a record for issuance. What's really interesting is that this record issuance has come about in a year where we've had at least a period of tremendous volatility in credit markets in March and April. And usually capital markets shut down during that period, and sometimes for an extended period of time for lower rated borrowers. You could look at the issuance levels as saying, well, this is great. There's demand. Credit markets are still healthy. Maybe we're getting late in the cycle. The big sort of elephant in the room here is the Fed. There is a large program out there for intervention in credit markets, both secondary and primary markets. Totals $750 billion. It has given the market confidence, and that's really played a big factor in keeping debt capital markets open. But there's a lot of economic uncertainty as well. So we're definitely going to see improvements in third quarter earnings over of what was a very, very poor second quarter. Overall, third quarter 2020 versus third quarter 19 is not going to look so good. We are facing a lot of uncertainty and a new wave. I wouldn't call it a second wave, maybe a third wave of COVID-19 spread. I think there's a wide range of possibilities around EBITDA for a lot of companies over the next couple of quarters. So overall in 2020, leverage is going up. And I think uncertainty is going up as well. And that is definitely a warning sign for credit markets.
The increase in leverage is a warning sign.
It's a warning sign, correct. And, probably to a higher degree, one, because of the level of earnings uncertainty, at least over the next, several quarters. And number two, because I think one could make a fairly safe assumption that without the input of the Fed, we probably wouldn't be near these issuance levels on a year-to-date basis. So if the market were making a decision without that influence, I don't think the access to capital would have been there.
And in that kind of scenario, what would you expect the market to look like? Higher yields and higher financing costs for companies?
Yeah, I think in the absence of the Fed intervention in the markets, the types of markets that, one, influence mom and pop and Main Street investors, but also the type of markets that make sure companies have liquidity they need to keep functioning. Fed interventions there, I think, were in March necessary and quite helpful. For the Fed to be buying actual corporate bonds in the secondary market, let alone exchange traded funds, was not an expected step. And much like government, zero interest rate policies have done, it's skewed risk appetites and perceptions of risk. In the absence of that step, the step that moved into the corporate bond markets, I think you would have seen a slower recovery in these markets. We'd probably be at higher spread levels than we are. Still, the top-rated borrowers and high-quality investment-grade borrowers would have regained access to markets, but I don't think money would have been as readily available for original issue high-yield borrowers, for instance.
How did management of the various ETFs that you oversee, how was that affected for you? I mean, what was it like managing a portfolio during that time? How were the underlying markets behaving, and how do you think ETFs performed given the way those markets were behaving?
The underlying markets for a brief period of time, at least, were quite broken might be too strong, but they were extremely illiquid. In transparency, in that there were just fewer transactions going through. And this goes, I'm not just talking about high yield credit or investment grade credit. This goes to like long dated treasury bonds or off the run treasuries where markets were, many points wide on bonds that usually trade, a penny wide or less. I haven't traded treasuries in a long time, but they're extremely, extremely, extremely liquid, right? That's sort of the model for liquidity in bond markets. Even the treasury market was very difficult to trade. And, the further you went out the liquidity curve, investment grade, high yield, emerging markets, there was, at least a several week period where bid asks were much wider, bids were often indicative. There was simply not a lot of liquidity in the secondary market. So it was actually difficult to gauge where, if you had to trade those bonds, where you could actually trade them, especially in size. So how did ETFs do? Well, the ones we manage and ETFs, across the fixed income space, by other providers too, they fell into discounts versus their net asset values. And that did get a lot of attention. Eventually they corrected. But during that period of time, what does that say about ETFs? What I think it says is they were actually doing their job. They were reflecting the cost to an investor who needed to sell of immediate liquidity. Because the ETF market makers who were bidding those ETFs at steep discounts to their net asset value were saying, I'm not going to be able to manage my risk as easily as I can during normal times. I might redeem these shares, get delivered bonds, and now I have a bunch of indicative bids for bonds, but the secondary market for those bonds is very difficult to judge. I might have to hold my positions for a long time. And my cost of hedging is up, and my cost of capital is going to be higher. So I'm going to bid at a bigger discount for that immediate liquidity you need. But really, again, what ETF industry has been making the case for a number of years is that ETFs will reflect the conditions of the market underlying those ETFs. And in a sense, they did. Those discounts were sort of an indication of where instantaneous liquidity was available in the market at the time. So again, ETFs were almost leading the price discovery process. They were a mechanism for price discovery. And as a result of that, you saw deep discounts. If you look at a wide range of investment grade and high yield ETFs, though, through this period, they track their indexes quite well. There's always some natural slippage due to fees and transaction costs, but they really, nothing broke in that sense from a index tracking point of view. ETFs, the vast majority of them are not leveraged instruments. And so there was not a high risk of that type of blow up of margin calls. And I think a lot of pundits that have been in the financial press or on some popular market news programs in recent years that have described ETFs as sort of the next bubble or something that could, undo the market during a period of stress. I think that period in March was a great test. And what ETFs did was they made it clear to investors that the markets were lower. They traded throughout the day. By being a price discovery mechanism, they're also sort of an advertisement for where the markets really are. But I think as a group, the industry came through quite well. I'd include our ETFs in that category.
So how about going forward? There's been some press and articles written about the whole 60-40 portfolio, and 60-40 is dead now. And what I'm referring to is, 60 the basic average asset allocation that somebody might have, 60% stocks, 40% bonds. The idea being you diversify between the two because during the downturn or what have you, they tend to offset one another. If you're a retiree, you're living off that 40%, you're getting your income. But today we're looking at near 0% on fixed income, just kind of generically. You're having to reach further out on the maturity spectrum, so you're probably adding a little bit of duration. Then what's the risk? The risk is, okay, maybe the Fed will keep the rates low for a while, but if rates start to go back up, that kind of puts some investors in a tough spot. They don't get the diversification that they were hoping. They don't get the income that they were hoping. And if rates go back up, they get hurt by the duration exposure.
Yeah, I think, and this is, a multi-trillion-dollar question. The 60-40 allocation dead, I don't actually, I think that still might describe estimates of what percentage of people's portfolios they might have in sort of traditional equities versus income-oriented assets. But instead of just saying bonds, maybe 60 equity, 40 bond, that 40%, as you say, is a much more nuanced approach to attaining income because, near zero rates on treasury, 10-year treasury yields, here in the last week of October at 80 basis points. That is not for most retirees on what they have saved. That's not going to really help them meet their income needs. So as you say, they are moving further out the risk spectrum. And then further to your point, they're either adding duration, adding credit risk, reducing liquidity, a variety of ways. Most individual investors aren't reducing liquidity, but a lot of institutional investors are. They're going to private markets, for instance, and getting a little more yield for in exchange for that liquidity give up. One issue with that, though, when you're going further out the credit curve in particular, you're buying assets that have higher correlations with equities, and you're losing that benefit that you mentioned right up front when you had a portfolio that was mostly treasuries and very, very high quality investment grade debt. That would actually have a negative correlation with equity markets. And you could actually have prices on those assets rise when equity valuations are going down, usually not to the same degree, but some protection. A bigger part of the 40% or whatever percent people have in fixed income now is they've moved away from treasuries, away from the highest credit quality in the search for yield, is that part of the portfolio is going to have a higher correlation with equities. So within that part of the portfolio now, people have to seek other ways of diversifying. And how do I find other lower correlations within fixed income? So they'll look internationally. That's one of the, again, reasons why institutional investors have moved toward the private space. Emerging markets are one of those answers. Still higher correlations with equities, but with higher yields and not as high as straight U.S. high yield or some other risk assets that are U.S. focused.
Yeah, you mentioned there was value in the market before. I don't know, are there still pockets of value to be found in the fixed income markets today?
Yeah, and again, you could look, well, not again, but to introduce a concept here, you could look at that on an absolute basis or a relative basis. And relatively speaking, there are pockets of value within fixed income. And I say relatively speaking, relative to very, very accommodative central bank policies that are being pursued, pretty much globally. Within that context, though, investment grade bonds and high yield bonds, pretty much their tightest levels, within 10 to 20 basis points for high yield of the tightest levels we've seen since the market turbulence happened, although still 150 plus basis points wider than they were at the beginning of the year. But anyway, within those markets, you can find some cheaper bonds, some oversold securities, some sectors that still could represent value depending upon your outlook for certain. And again, for fixed income, over the long run, it's carry that really explains the majority of your returns. So it's not totally irrational to seek assets that actually have yield. And that's one of the arguments for continued allocations to high yield right now. But there are other things as well. We're seeing increased interest in Chinese bonds. Sounds maybe to some people exotic or a big reach, but actually what you're talking about is the second largest bond market in the world. For many, many years, people have been allocating to international fixed income, mostly European bonds. Well, yields in Europe are on average, much lower than the U.S. Many countries with negative yields across Europe. China has, depending upon where you look on the curve, 230 plus basis point pickup in yield as we're talking now in late October versus U.S. Treasuries. It is the second largest bond market in the world. It's got a currency that is controlled. It floats to some degree, but it's managed against a basket of other currencies, not just managed against the US dollar. That currency, China has been, out of the COVID-19 related crisis, China has been leading the reemergence of growth globally, which is actually supportive of its currency. So yield, potential currency gains, that's been, a new space that people are looking at. Same time, China's been added to a variety of both global and emerging market bond indexes.
I was going to make that point or ask you about that. They've been recently added to the FTSE big index. I forget the name right now, though.
WIGB.
World Government Bond
The world,
Index.
yeah.
Yeah. Which was the third major index provider to add Chinese bonds to their index, and perhaps the most influential, just kind of based on the number of assets that follow that. Have China bonds gone mainstream now? I mean, whether you realize it or not, individual investors, U.S. investors will probably have exposure to it.
Eventually, the FTSE announcement is something that won't be implemented until, start being implemented. It'll be phased in until sometime next year. Actually, believe that starting next September. You mentioned two other indexers, Bloomberg, Barclays indexes, and JP Morgan on the emerging market side. China is now closer to more complete inclusion in those indexes. So if you are, if you own JP Morgan local currency index related products like our EMLC tracks, a JP Morgan fund, you do already have exposure, or global indexes that, global funds that reference Bloomberg Barclays indexes, you probably do have some China exposure. Not close to what its weight actually is in the global bond markets, but some. But it's not gone totally mainstream. I mean, the money to come there from foreigners is, what's to come is much greater than what's already invested. There's several hundred billion of potential additional investors. But this is, again, a multi-trillion-dollar market overall, and the vast majority of bonds are held by locals. And the market hasn't been fully opened yet. I think there's a long way to go there in terms of foreign investor adoption of China as a key part of portfolios.
Let's talk about another area that has gotten a lot of media attention this year and maybe become a household term called fallen angels. I think the ETF that VanEck has seen something like 1.6 billion, maybe approaching 1.8 billion year to date in net new flows. You were around when we launched Angel, right? Or did you come right after that?
Yeah, actually, I came about a month or 2 months before we launched. And in fact, we were launching 3 new credit funds at the time. And so I was joining to help with the launch from a PM perspective and to manage those funds. I am going to just interject here, Ed, that I know you remember the launch because this was your concept. This was an idea that you had come up with. And when I met with Jan VanEck and Adam Phillips, the COO of our ETF business, to come join VanEck in 2012, this was a fund they were already quite excited about. Of course, it did take some time for it to get some assets.
Yeah, it did. And I remember at one point we had pondered, well, no one knows what this term fallen angel is. Even financial professionals. I think you had to be a bond guy to really understand what a fallen angel was or have heard about it. And we pondered maybe we should change the name. Let's go over what a fallen angel is just briefly and then talk about the case for a fallen angel strategy.
Sure. So fallen angel is a high yield bond that was originally issued as an investment grade bond. So the sort of demarcation between investment grade and high yield is BBB minus is the lowest rung of by S&P ratings, but we'll use that as the proxy for all ratings, the lowest rung of investment grade, and a BB plus is the highest high yield or sub-investment grade rating. When a bond's average rating falls below BBB minus to BB plus or lower, a bond that was originally issued as an investment grade bond, it becomes a fallen angel. We, in our product, track an ICE index, which originally was the Bank of America Merrill Lynch indexes. That ICE index does apply that average rating type rule. These bonds tend to be from larger issuers, since they were originally investment grade borrowers, usually older, more established companies, definitely higher, the ones who are public, which the vast majority are, higher average equity market caps than the original issue high yield universe. That's the general definition of a fallen angel.
Is there a time that's better to invest in fallen angels, or a particular market cycle when that strategy tends to do better than others?
Yeah, there's a really interesting correlation between volumes of new fallen angels and returns, both in the absolute sense, but also relative to broad high yield. So in other words, the best years to buy a fallen angel fund have been the years where there's the biggest occurrence of new fallen angels, when there are a lot of downgrades. I do want to note without being too pitchy though, that because of the quality and sometimes different sector makeup, the index that ICE started tracking fallen angels, they started in 2004. So there are 16 complete years of returns, and fallen angels have outperformed broad high yield 12 of those 16 years. So there really is a through the cycle case, but certainly the best years. And 2020 is one of those years with extremely high volume of new fallen angels. And that has meant meaningful outperformance year to date. It's certainly not locked in for 2020 yet, but year to date versus broad high yield.
So there's been something like 150 billion of new fallen angels this year. Are you expecting more? And what are some of the names that somebody might find in a fallen angel portfolio or that have become fallen angels this year?
Yeah. So in fact, it's probably now between 160, 170 billion for US fallen angels year to date there, which is an annual record. Not as a percentage of the investment grade universe, which has grown so much over the last decade, but just in absolute terms, the largest market value of fallen angels previously seen was 100 billion in 2005, which was mainly automotives. Speaking of which, I mean, you asked what are the larger names. Ford is a fallen angel for the second time because it was part of that 2005 universe as well. So that is one of the larger names that have been downgraded this year in 2020. Kraft Heinz is actually downgraded in February. Occidental Petroleum, which is a fairly well-known name in the energy space. When we launched the fund, Sprint was in the index. Sprint still has a bond in our index, by the way, a well-known name. Anything that Sprint has issued as a high yield borrower since then is not considered a fallen angel. So those are some of the names that I'm sure our listeners are familiar with.
I know sector concentration is sometimes a risk, but the sector concentration of the fallen angel strategy tends to reflect a lagging indicator of what's happened in the markets, right, in the economy.
Yeah, and it's sort of an application of the same thing that happens on a micro level. When describing what a fallen angel bond was, I probably should have mentioned that the typical experience of that bond is that it suffers a much larger price loss when its average rating falls from something in the triple B space to something in the double B space. And that's because it's changing universes. It's moving from investment grade portfolios to high yield portfolios. There's a high degree of forced selling. But those high yield portfolios are not necessarily forced buyers, particularly on the active side. So there tends to be a big gap, and that has tended to lead to value, which is why big volumes of fallen angels have led to really, really good opportunities. So I digress, and I want to get back to the original question here, which was about sectors. And much like an individual issuer whose bonds fall out of favor because they're undergoing some type of credit deterioration, either just increased leverage, bad acquisition. Often it's new competition, declining margins, or it might even be a declining industry. But downgrades tend to happen around the same time that defaults are happening at the lower end of the spectrum. All of those types of occurrences tend to be most prevalent after the credit cycle's bottomed out. So when a sector like energy becomes the most out of favor sector, and for good reasons at times, too much leverage, energy prices fall, et cetera. When you start seeing big waves of downgrades and a lot of defaults, which again tend to happen around the same time, usually the energy sector, this happened in 2015 and 16, and it's actually happened again in 2020, that sector has already priced in a lot of risk. It does not mean that there won't be more defaults, more downgrades, potentially further price deterioration. But as you say, downgrades and defaults both tend to be lagging indicators. And by the time those are occurring, often there's enough risk priced in to markets to represent value. That could happen across the credit universe from a sector perspective, or sometimes it does happen with individual sectors. It happened with automotives in 2005. It happened with banks in 2009, and again in 2011 and 12 around the European financial crisis, where these were the out of favor sectors, but they actually represented value by the time those fallen angels were occurring. And our index took on large concentrations in those sectors, as it has done with energy.
Let me ask you about another risk, and that being duration. Since these were fallen angels were originally issued as investment grade, they probably had a longer maturity profile and probably had a longer duration, and they fall into high yield. Relative to broad high yield, they might have a longer duration than broad high yield. Is that a real risk, or is that a perceived risk when you also take into account the discount that some of these bonds come into the index at?
It's definitely a perceived risk, and at times a real one. But over most medium to long periods of time, high yield has a negative correlation with treasuries. So when treasury bond prices are falling, that would mean that directionally, usually high yield bond prices are rising. In fact, over the last 5 years, both broad high yield and fallen angels have had a negative correlation with treasuries. So that would be one indicator that, from an interest rate perspective, duration doesn't matter as much. Of course, correlation with treasuries will hinge at times on how tight spreads are. So when high yield is at 300 basis points versus where it is today at 500 basis points, there might be a little higher or less negative correlation with treasuries at that point in time. And 2018, we had low rates coming into the year. Rates rose a little bit. Spreads were much tighter than they are now, and that duration did matter a little bit. Generally speaking, through the cycle, it's actually had very little to do with explaining returns of fallen angels versus broad high yield. Duration has another impact, though, in terms of credit spread duration. And when you're looking at a market recovery and spreads are coming in from wider levels, sometimes that credit spread duration does enhance the return of fallen angels. When spreads widen, it could have the opposite impact. But again, usually other factors have been important, such as the high double B component within fallen angels.
That's great. Let's move on to kind of trends. Fran, what is one long-term trend you see playing out over the next year to several years?
Well, I actually think the bottom of this credit cycle is going to extend for at least another 12 months. So getting back to it, another question, I think we will see more episodes of downgrades and defaults, which will probably cause some adverse reactions in the markets, but should lead to other pockets of value. I believe we're going to see a longer bottom of the credit cycle. Might not be reflected in prices, but in terms of downgrades and credit actions in general, that is one trend we'll see. Of course, over a longer, that's sort of a 12-month view. Longer term trends, since we're here talking about fixed income ETFs, I think you'll continue to see innovation there from a variety of ETF providers, whereas I am not a person who thinks that it's automatic that we'll see tremendous growth in actively managed ETFs in the fixed income space. I still think we'll see further innovation in other ways in that space and continued growth of the market.
All right, so let's do trend or fad. Trend or fad, connected home fitness. Are you a Peloton guy?
It's funny. We're sort of a split household on the Peloton thing. We have one devotee, and I wouldn't call myself a naysayer, just not a devotee. I'm going to stay with trend on that, despite my own personal feelings.
Cryptocurrency, trend or fad?
Trend. I think any coin that is in the market today could be a fad, but I think I'm in the minority on that note.
And face mask for the long term, trend or fad?
I think seasonal or occasional mask wearing, just to combat the flu. Now that people have gotten used to it, might not go away. But I'm more of an optimist in terms of it might be 12 months down the road. The timing is a little more difficult, but perhaps you'll see more of the globe use masks, at least on an occasional or seasonal basis, to combat higher occurrences of getting a bug.
This has been great. Fran, thank you very much for your time. And thank you for tuning in to another episode of Trends with Benefits.